the chapter 2, the reviews of accounting. Yeah. Reviews accounting. Okay, our chapter content is that income statement, the price earning ratio, the balance sheet, the statement of cash flow, tax consideration and depreciation. Now we go to the content number 1 in the income statement. Here our financial management is focusing on especially the corporate finance. So the model of how to do the income statement, we follow the form of the corporation. As in our chapter 1, there are 3 forms of a company, 3 forms of organization. One is that sole proprietorship, 2 is that partnership, and the 3rd one is a corporation. So is the form that are a little bit different or the financial report, but the more complex is that the corporate finance, that it's a financial report look like more than the other the company like sole proprietorship or partnership. Because the form of organization like a corporation, it means that this company have also right to sell or issue the stocks or bond to sell in the market, in the security market, to collect fund or to enlarge his capital and enlarge his company, to run his company. This income statement is starting from the share or share revenue. For this, okay, it is 2010, end of year, and total are 2 million. And number 2 is cost of goods sold, and number 3 it is the group of it. Group of it is that coming from the share, share minus cost of goods sold, mean that share minus cost of goods sold, it is the group profit. And number 4 is the selling and administrative expense, that calling as the operating expense, we can say, including number 5, depreciation expense. This 4 and 5 is that we can talking it as the operating expense. And number 6 is coming from the number 3, and number 3 minus number 4 and 5, number 4 and 5, yeah. So it is the operating profit, or we can say earning before interest and tax, earning before interest and tax. The total is that $180,000. Everybody had to take note that for the unit of dollar, we start at the line number 1, the number other, no, I mean like that. And then number spend is that the interest spend. Number 8 is coming from the number 6, number 6 minus number 7. It is the earning before tax, mean that earning not yet pay tax yet. Interest spend is in the report is that 20,000, 20,000 here. When you operating profit minus interest spend, it is the earning before tax and limit of tax. Total is that 160,000. And for tax is that 49,500. And number 10 is coming from the number 8, yeah, number 8 minus number 9. Okay, it is number 10. It is calling as the earning after tax, and after tax. That normally in the sole proprietorship or partnership calling, it is the net income, it is the net income or profit. You can say it is a net income. Something like that. But normally this word used with the form of the company, simply company, or partnership or sole proprietorships. And for the earning after tax here, actually can use the word is normally used in the corporate finance or uh, the general company also can use us also, and it just means that the net income. And then number 11 is that the preferred stock dividend, mean that the dividend paid for the preferred stockholder first. Total dividend paid for this year and next year is that one 10,500, yeah, $10,500. Number 12, is that the earning available to common stockholder. It is coming from number 10 minus number 11. Number 11. This is the earning available to common stockholder. The total is that 100 USD per day. Yeah. It's the income statement of Krama Corporation. But if you're looking about the total share, the total share outstanding in the market, outstanding or in at hand of the common stockholder, there are total 100,000 share, 100,000 share. So the number 14 is that coming from the number 12 divided by number 13. to look through that, to look that if earning per share, how much earning per share for each common share, total $1 of earning per share. Everybody have to look back to the accounting equation that asset it is equal to the debt or liability plus equity over here. In the equity or shareholder, there are two main shares. One is calling as the preferred stocks, the preferred stock share or preferred stock shareholder. Preferred stock. You can say it is the priority stock. The people who hold this share, he has the first right to get the dividend. I mean that the dividend had to pay for this kind of shareholder first, and then keep other or the amount that left available, that calling as the amount available or earning available to common share stockholder. So the preferred stockholder is the priority stock, priority stockholder. And the second one is that the common stock, yeah, or common. The total of the share, the common stock share or common stock, yeah, you can say common stock, common stock. Mean that common stock holder. So the people who hold each share mean that he has a right to get a dividend for preferred stockholder, dividend for common stockholder, as what in our income statement number 11 and number 12. Number 12 over here. Yeah, number 11 is the dividend paid for the sorry. Number 11 here. Okay. The people who hold the preferred stock mean he will get the dividend priority to get the dividend before the people who hold the common share, who hold the common share, common stock. So there are two main kind in the stock of stockholder equity. One is that the preferred stock, and two is the common stock. For the part of liability or debt, actually the company also can issue this part of finance to the public investor. The purpose is that to collect fund or to enlarge the capital to run his company. Then this part called bond. Bond over here, bond. In Cambodia said ban bom no, mean that the people who hold this part of certificate, he will be the creditor, but the company who issuer, he is the debtor. And with life of bond, it is has the maturity debt and debt, but the life of preferred stock or common stock, it is no maturity debt. The people who hold bond, he will get, one is that interest. Yeah, the company will pay interest for him, the people who hold bond. Okay, and then when the time is end to the maturity debt, he will get his principal. Yeah, principal. Okay. So this is the kind of fund. But if we're talking about the stock, some preferred stock or common stock, the people who hold the common stock or preferred stock, he is the shareholder. The benefit he get from the company is dividend, not interest. The people who hold this part of this common stock or preferred stock, they are the shareholder, and they get the dividend as the benefit. But if the company no benefit or non-profit, he get neither zero, no benefit to him, because what he get is that the dividend. But the people who hold the hold the bond, even if the company non-profit or the company is lost, he still get the interest as the time period, and when the maturity is finished, so he get principal and interest as well. So the people who buy bond, he look like no risk, or his risk is very low. But the people who invest or buy stock, like preferred stock or common stock, mean that risk. I mean, if the company lost, he also no any benefit. So this is a part of structure, part of capital structure, we can say, of the company as a whole. Yeah, there are two parts. One is that debt. Two is that equity or shareholder equity. Yeah, shareholder equity. Total bond, preferred stock or stock, they are a part of security. If we talk about security, security means that mulabat. In Cambodian say mulabat. We talk about security. Yeah, security. There will be bond and stock. Okay. Stock. You talk about stock, there will be preferred stock, and common stock. Yeah. Everybody had to take note that normally common stock, it is very popular if the company who need the money or fund to enlarge its company, Normally they are issue common stock to sell in the market to collect the fund or capital or to unlock his company. And preferred stock is very rare, very rare to issue. Yeah. And other is that bond. Yeah, bond also popular one. Yeah. But the most popular is the common stock. That the company who would like to collect his fund to run his company or lock the company normally issue common stock also sell in the market, in the security market, and collect fund to unlock his company or run his company. So if one know any mean that is unclear, you can ask me. Okay, you can ask me for this statement. This statement. We go to the PE ratio. What is PE ratio? Yeah, P, it is the market price. E, it is earning per share. So PE ratio it is equal to the market price of stock divided by earning per share divided by earning per share. And the meaning of PE ratio it is a way of measuring the desirability of the stock. It indicates the expectation about the future of the company. The PE ratio is influenced by the earning and share growth of the firm, risk or volatility in performance, debt security structure of the firm, dividend payment policy, and quality of management. All will be influenced to the PE ratio. And why we can say that the PE is the indicate the expectation about the future of the company, and why we say that it is a way measuring the desirability of the stock. As you can see that P means that's the market price of stock. E means that earning per share, earning per share, earning per share. In the case that if earning per share it is down, sharply down to number 0. It look like PE. Look like here it is very fast grows up. Okay, so it is down to number 0 means that the company is no profit. Is no profit, and it will make the PE ratio increase, sharply increase. And in other cases that the economics it is look like deficit or crisis, the people will dislike to buy the stocks, or he would like to withdraw his money back or sell out to collect his money back. And in the case of the economic look like a crisis or uh, the situation, the natural situation, for example. So this case will make P running down also, will make PE ratio faster down. So this case is making that the company future it is not good. The PE ratio is that down fast, uh, increase fast. It's showing that the company expected the future of the company look like to be shut down, it's like that. And other way, it is look like the people who dislike this PE ratio for of those company as well. Now you look the table, uh, table number 2, 3, to talk about the PE ratio of this company or this company. This is a kind of corporation. This industry, industry, and this year, okay, this year. Now you look at the corporation Bank of America. The industry of this corporation is the banking or bank. Uh, the P ratio in 1990 is at 11. P ratio in 1994 is at 8, means a little bit down. And then P ratio in 1998 is at 19, is at increase. And P ratio in 2001 it is a little bit down, and it is a little bit down, and it's down, but little bit down, not sharply down. Looking the corporation CISO, yeah, it is networking industry. The PE ratio in 2019, it's 25, yeah, 24, 30, 37, and then increase sharply to, yeah, to 91, okay, 91. You see, if you increase like this, mean that earning per share or profit, yeah, or earning of the total of this company look like nearly number zero, nearly number zero. So it look like the company is the no profit, no any profit in this year. And then going to number 23 again, and number 24, number 22, number 2. Yeah, it is the stable again. So this year, 2001, 2003, 2004, look like the company is try to make his running better again. This is a part of what that you have to decide. Should share your money to this company as to be as the shareholder with the company or not. Yeah. If you look like if you when you see that the PE ratio is this is stable, but this is unstable. It was up, and this is stable again. But the kind of thing America look like very stable. Yes, a very stable one. That it is creditable. I mean that. And you see the company number 3, General Motors, the part it is the industry, automobile industry. Starting from the P ratio number 7, number 8, and then number 13, number 6. Yeah, this part one that it look like very increase. Yeah, number 40, and then more increase that to DD. DD it look like it look like a very infinite amount. You know, DD here you see this star note. It means that the company is operating at a deficit and has no PE ratio at the time because there are no earnings, so there are no earnings. So it means that P divide number 0, so it is equal to in indefinite amount over here. So we calling as the it is the no profit or no earning, no earning. So this is the that. So General Motto here, if you mean that in the around of this year look like not make you have a decide to the stock of this company, you are not interested in this company, so you should not decide to invest or share your part of money to this company to be a shareholder. Okay, but these two, just this line number 1 look like good or better, and number 2 it does as well, but except for 2001, it look like the company look not more benefit, more profit. But for the company number 3 is that yeah, incredible. The future mean that if from 2001, 2006, 2010, is this still continuing? Mean that this company look like nearly shutting down. I mean that. I mean no profit, for this company, for the company. The company number 4, Intel, it is the kind of industry that the integrated circuit mà in và visa berang ada sequi integrate circuit 12, 11, 4, 24, 20, 21, 29, okay, and other, yeah, other number 14, 7, 24, yeah, look like incredible, and so as airline starting from number 15, 20, yeah, it is increase, and then down, increase, increase, and then more increase, okay, yeah. Okay, it look like no earning in 2024 social airlines. Like looking today, the airline company as the COVID-19 or from the beginning of the year. So this airline is also earning from the airline look like down also down. So this a part that we have to consider if the year or the period still continue. The airline companies is also look like as no any earning if the COVID-19 still continue as well. But we hope that someday we will be well. Okay. Taxtron diversity industry start from number 7, number 11, 27, 29, 19, and 19, 18. Okay. Walmart retail 24, 21, 31, 38, 18, and 16. Another is that the Standard and Poor 500 stock index. This is a part of a collective company, credible collective company. Most of people who want to invest or to be a part of investor, normally he consider lump sum company, but a credible one. Uh, Starting from number 15, 20, 23, 26, 24, 20. Yes, very stable. Okay, you can see it is very stable one. It's stable, yeah. Okay, stable. So most people who, if he cannot analyze what company is better, he can go to this part of this company is better. Okay, the company better because this is the collective company. The mean that the standard most of them are agreeable one, agreeable one. Um, so the PE ratio indicates the expectation about the future of the company. A firm expected to provide return greater than those for the market in general with equal or less risk. Equal or less risk. So at least the risk is very low. Benefit is more than okay. Often have PE ratio higher than the PE ratio of market PE ratio. It is very good to compare your PE ratio to the competitor and industry as whole. So to compare the PE ratio with other companies, especially the competitors, the company had the same as in the kind of industry as a whole. Now we go to the report number 2 of the EU accounting is that balance sheet. Balance sheet. As you knew already that the balance sheet is starting from the asset equal to the liability plus the owner or shareholder equity. Shareholder equity that normally easy to know that are low. Okay. Looking again for the Grammar Corporation, yes, from the Corporation for the statement of the end year number 2010. The first is that the asset, and then the current asset. The current asset include cash. Cash is the number one, line one of the current asset. There are 40,000, and marketable security it is 10,000. Account receivable it is 220,000. Less allowance for that bad debt. You know what is the allowance for that bad debt? What is the allowance for bad debt? Why it is less? So less allowance for that bad debt is 20,000. It is 200,000. 200,000 here. It is calling as the. It is called yeah as the net. You can say net account receivable. Net account receivable. Okay. It is a net account receivable. That's equal to the account receivable minus allowance for bad debt. Everybody, do you remember what is the allowance for bad debt? What is allowance for that? What is allowance for bad debt? What is that? Allowance for bad debt. It is the provision. Yeah, it is the provision account, or we can take the extra account of the receivable. Extra account receivable. Mean that In the accounting rule, as all asset, yeah, except for depreciation and allowance for bad debt, it is increased at the left side, correct? At the left side, decrease at the right side. This is asset, part of asset. All of our asset at the accounting rule, it is increase at the left side, a decrease at the at the right side, at the right side. But depreciation or allowance for bad debt, it is increased at the, we can say it is a contra asset, the contra asset, yeah, contra asset, like depreciation or allowance for that bad debt. Yeah, it is contra asset, mean that it increase at the right side or decrease at the left side, decrease at the left side. But is this also the asset? But when we when the even mean that when we record in the transaction, increase the right side, yeah, decrease at the left side, the left side. This is why it is less, yeah, less. This is one. Allowance for bad debt, looking at the uh, contra account, sorry, as the provision account, It is here the loan committee, especially from bank or other company, who also always estimate the part that the people who did not pay back uh, the receivable account. For example, if he estimate that, oh, amount this year amount of 0.1% of loan sale or loan or receivable, yeah, or loan. The people or sell, we can say, the people will not pay back, For example, is estimated uh, 20,000 will not pay back, 22 or 22,000, yeah. So he will record a part of one is that bad debt spend, yeah, bad debt spend, bad debt, bad debt spend, yeah, bad debt spend. For example, it is the 2000. Yeah, 22,000 for example. And other is that the provision for bad debt, or we can say allowance, yeah, allowance for bad debt, allowance for debt. This is the right side, the left side. Okay. Sorry. This one, I mean the expense we increase at the left side. 22, 22,000 estimate like that. No money flow out yet. I mean, but only estimate. This include the right side, okay? 22,000, 22,000, for example, like that. At the beginning of the year, Allowance for bad debt, okay? For bad debt, yeah. So in the period of the year when you check that, oh, there are uh, the that the A, B, C, he cannot pay back to the company, mean that we will have to delete or write off this name from the account receivable book. So for example, there are 2,000. You see that, oh, at least 2,000 he cannot pay back to the company. So we have to delete this company in this year. In this delete his account or delete these people from the collectible account this year. For example, at least 2,000 is happened. So when 2,000 happen, you write down it's at the right side or left side over here. Contra with the uh, accountable account. Yeah, 2,000. This is a accounts receivable book. Okay. You write off 2000. 2000. Okay. This part. Okay. Called as write off. Yeah, write off. You write off mean that you delete the 2000 account from the account receivable. Delete this before. You write off. Okay. So the balance of the allowance for bad debt is at 22 or 20,000 at the end of year. At the end of year. At the end of year. So this allowance for bad debt, you can note that it is the provision account. It is the contra asset, contra to the account receivable. It is a part account to use to write off the account receivable to for the debtor who cannot pay back to the company, and the loan or committee decide that to delete this name from the account receivable book, and then the write-offs will happen between the account receivable and allowance for bad debt. So this is the reason why we minus, okay, we minus. You check that the net of account receivable is only 200,000 USD. It means that look like there are a total amount of 220,000 of the total account receivable. Those there are at least the bad debt or the people who cannot pay or under the estimation that cannot pay back to the company. There are 20,000 total. The net account receivable means that the account receivable or account that can collect the company expect that he can collect the money from the debtor only 200,000. This is the yeah in the line with less lower corporate debt, but actually it means that it is the net account receivable, net account receivable. It is a net account receivable. Okay, 200,000. Go to the inventory. Inventory there are 180,000. Prepaid spend it is 20,000. And total current asset, it is the 450,000. Other asset or long-term asset, we can say, including if we talking about the long-term, including fixed asset. Yeah. Other asset, it is investment. Investment there are 50,000. Fixed asset, or long-term asset, plant and equipment. In original cost there are 1,100,000. Assume that for depreciation less. Okay, so it is what did I say, that the depreciation or loan for bad debt, they are the contra asset. Yeah. It make the asset minus. Accumulated depreciation make the original cost of the plant or equipment or asset, it is down also. It is down also, meaning the because of the depreciate, total is at 600,000, and to that this cost minus depreciation, it is the less cost. Yeah, the less cost. Or we can net plant and equipment. Total are 500,000. Okay. And now total asset, mean that including the current asset, other asset, and fixed asset, total are 1 million. 1 million. Coming from the total current asset plus other asset plus fixed asset. 1 million. We go to the structure, a part of debt or liability and stockholder equity, that are debt or liability. There are current liability include current liability, it is the like account payable, note payable, accrued spend. Total are current liability. You know, the current liability means that the payable account under the year mean that we have to pay back to our vendor or grade them in the year. We calling them as the current liability. For the account payable, different from not payable. Okay, account payable and not payable, it is different. You have to take note that it is different. Different. What is different? Everybody who know this. Mình nhận đạt đẳng ấy. Hãy account payable và not payable có nghĩa được nhỉ? Hello.
Yes, teacher.
What is the difference between account payable and not payable? All of them are part of payable, even is the accrued spend. You know what is different between account and not payable?
I think account payable is for short term and note payable for long term.
Okay, and other one. You know, you have to take note that the all are under the current liability. Current liability mean that short term. Mean that the liability, mean that the payable account that under the year, mean in the year, sorry, in the year, only at least 12 months. And other liability that we have to pay back to the vendor or our creditor longer than 1 year, we calling them as the long-term liability, not current liability. But what difference between account payable and not payable? All of them are short-term the same now. Who know it?
Accounts payable, it is amount owed, open account to suppliers, and notes payable, it like the amount that sign obligations to the banker or others, the creditors.
Yeah, good. Okay, correct one. Everybody has to take note. Note mean that the money nearly look like money. uh, the payable mean that we have to pay like banker, creditor who give loan to us, and we have to pay back them. This one calling as the note payable, and account payable. For account payable mean that the payable account that we buy something from vendor and we did not pay them yet, so we have to pay them someday later. This one called as the account payable. Different like that. Your bán nó nè. Hello. Do you understand all of them? Your bán nè, slide mình.
Yes.
Yeah, okay. Mean that it is like that. One is note, one is account. Note it mean that you make loan from the lender, and account payable mean that you buy something from the buyer or vendor, but we did not pay to them yet. This is called one as the account payable. All of them are in the current liability, mean that we have to pay them in the year in the period of 12 months. So other payable account that we have to pay them next year or other year, not in the year, is the long-term liability. Long-term liability. Now accrued spend, yeah, accrued spend also part of account payable, but it is accrued. Okay, it is accrued mean that we accrue them. We accrue them. We accept them as the expense, but get paid. Like tax payable, also part of the accrued spend. Other interest payable, also part of the accrued spend. Because, for example, if you open the fixed, if some people who open a fixed asset with us, but fixed, I mean the fixed account with us and with the period of 3 months or 6 months. We are banker, but we have to pay them each month interest. But actually, we did not pay it. We paid when at the maturity. So this part calling as the accrue interest payment. Uh, we have mean that we accept them as the expense already, but yet paid the interest to them each month. We wait to the maturity 3 months or 6 months, so we will pay totally uh, all each month calling accrue expense. Accrue expense. I mean that it's a payable account like interest payable, tax payable. Okay. Total three of them are calling as the current liability. 210,000. Now we go to long-term liability. This, this year is the end of year 2010, but this liability we have to pay them in the year of 2015, mean that 5 years later. So we call them as the long-term liability. There are 900,000, sorry, 90,000. The total liability between current and long term are 300,000, 300,000. 210 plus 90, that is 300,000. Now we go to the part of stockholder equity. There are two parts. One is preferred stock, and the second one is the common stock. Now we go to part one of the stockholder equity. Preferred stock. Preferred stock, there are 100 par value. With share, total share are 500 share. 500 share. So the 500 share, there are 500 share. One share is cost 100, 100 par value mean that it is the face value. So the top in par value mean face value. Okay. It means face value. Face value or par value. The value has to already reflect, reflect in the share or on the share, sorry. So one share vested with the value 100, or we can say par value. Total of 500 share multiplied by 100. There are 50,000 USD. And we go to common stock. Common stock for each face value or par value, it is $1. $1. The total share are 100,000 share. So you multiply them. It is the in the value that 100,000 USD. Capital paid in excess of par. It is also part. It is also common stock. There are 250,000. You know what is the capital paid in excess? What is that? Everybody have know it. What is capital paid in excess? They are also common stock. Capital, yeah, capital paid, yeah, in excess. What is that? What is capital paid in excess? Hmm? People who know it, minute đằng ấy. What is capital paid in excess? You look again for the common stock share. Par value is $1. I mean that look like money. This is a certificate of common stock share. The par value or fair value is $1. Already printed. But when the issuer who issued this part of share or part of the certificate to the market, he or the company did not sell at the face value price, but he sold in the market with the price of $3.5. Mean that he collect the money to run or to enlarge his capital is the $3.5, not $1. So This 3.5 will divide two parts. One calling as the power value. $1 will be divided as the power value. Okay. And 2.5 will be called as the excess power value. Excess power. The company collects $3.5 from the shareholder, but in order to make known that what is the power due amount he collects, it is the $1 per share. It is the power due amount of paper due, and other it is calling as the capital paid in excess of par. It is still the coupon stock, okay? So 1.5 multiplied with total share 100,000 share, it is the $250,000. Okay. Just divide two part. One is power due part, and other is excess power due part. Value parts. And then they did a return earning. What is return earning? Every day have to take note. What is return earning? Return earning also a part of common stockholder. Return earning, yeah, return earning means that all the earning after tax, earning after tax divide sorry minus dividend, dividend for previous stock, dividend for previous stock, okay, and dividend for common stock, yeah, it is the return earning, return earning. Mean that the earning that we retain to for the company, to allow the company earning after tax or net income after the minus dividend. Dividend here include dividend for preferred stock and common stock. Preferred stock and common stock, and we calling as a return earning actually. A total 300,000. So here preferred stock, common stock, capital paying assets, returning calling as the stockholder equity, total stockholder equity are $7,000, $700,000. It is coming from the 50 plus 100 plus 250 plus 300. It is total 700,000. This is the total equity, and we plus the total liability. It is 1 million, the same as I said. Same as I said. Okay, same as I said over here. Now we go to the market value and it's book value. What is market value? So what is book value? If we talk about a market value, it means that it is equal to the price of share of common stock at a certain of that. So the market value here means that the price of stock. And if we talk about the book value, it means that the total asset minus total liability and people stock. Everybody has to note that if we talk about the share price or just the stock price, it means that see the in the balance sheet it is asset equal to the liability plus equity. Equity will divide to the people stock and common stock and common stock and common stock. If we talk about the book value, we talk about the common stock. Yeah, book value. Okay. If we talk about the book value, we talk about the common stock. Talk about the common stock. So, how do you compute the common stock or book value total over here? It will be equal to the asset, yeah, minus liability, minus previous stock. Okay, previous stock, like that. So this part, yeah, include you take asset minus liability and previous stock. It is will be the book value, or we can say the common stock. We can say that all from the balance sheet as shown here. This is called net worth or book value. So we can call book value, or we can call net worth. Yeah, net worth. We call net worth. The purpose is that to know is the common stock increase value or not, increase value or not. After you running the company for a 1 or 2 3 year, blah blah blah, and then you check again is the common stock value increase or decrease. Is asset increase? Yeah. Liability increase a little bit as well, and then you check that is common stock increase or not. If it increase, mean that you make a profit or make earning, but if it decrease, mean that you did not earn any profit. So this is part of book value. Book value, it look like the value of your share, and then you have to compare with the market value. If your share value in the book not increase, so how the price in the market increase as well. That's the reason that you have to compare between market value and book value. Book value coming from your company running, and to check your common stock or your share, part of share, it is increased value or not. So this will affect to the stock price in the market, can be a share better or good share or not. There's a affect to your will like that. So will like that. Because the purpose of financier is that to make a house the uh, stockholder will, or the common share increase the value, its value in the value, at least unless your company is good, mean that it's earn more profit, make your common stockholder with value its share, and then can affect to the market value. This is part of what that a financier had to do, the goal of financier had to do, to maximize shareholder value. So you can look again for from the asset. Total asset is that 1 million minus liability. It is the 700,000. It is the stockholder equity, and you minus the previous stock obligation or dividend. It is the y 15, yeah, 15 dollar, 15,000, and yeah, after then you, yeah, we will arrive to be as the net worth assigned to common stock. And total of common stock share is that 100,000 share. You net worth, or we can say book value per share, it is coming from the common stock net worth assigned to common, divide by total share. It is as the we can say it is the book value. The book value. Okay, everybody, we can take rest from now, and I will upload, sorry, submit to one exercise related to the income statement, balance sheet, and how to come to the book value and market value. Okay, we break a little bit here. តោះនេះយើងសម្រាប់នំប៉ុណ្ណឹងតិចសិនណាបាទ